DK, always good to see you. Good morning.
Good morning, Carl.
I thought of you last night. I was reading Jan Hatzius's note, your colleague over at Goldman, looking at the economy and specifically what he called the broadening of wage and price pressures across advanced economies. He says that growth needs to slow. In fact, the title of the report is The Slowdown We Need. And that includes a bigger potential drawdown in the major DM equity markets relative to the post-COVID recovery so far. Do you think asset prices need to come in?
Well, I think part of that analysis and discussion is about the tightening financial conditions that we at Goldman Sachs are anticipating. And that comes in a variety of ways. One is through some tightening by the Federal Reserve. There's higher bond yields, both in a nominal and a real basis. And it does lead potentially to lower equity prices. Or another way of saying that is that earnings are really necessary in order to lift share prices. And so I think that is leading to a certain bifurcation, Carl, in the equity market. And what you saw in this quarter so far, we're pretty much towards the tail end of the fourth quarter results. And what's happening so far is companies that have missed expectations have been severely punished, if you will, in their share performance. But in addition, Carl, the companies that have actually beat expectations have lowered their guidance for profits in the next quarter as well as for calendar year 2022. So I think the idea of tightening financial conditions puts incrementally more importance on the growth prospects of individual companies. So the earnings is going to be the key story that we're focusing on right now.
Yep. It makes perfect sense, although I'm just looking at, let's take a chart of Alphabet today, David, which is, as of now, given back all of the gains on the share price that it got in the wake of what was a stellar earnings report. I guess I'm wondering, do you think earnings are going to be enough to maintain? Are you still at 5,100 year end?
So the answer is yes. Our published forecast is at 5,100. The way we're focusing on right now is in a tightening financial conditions environment. Historically, what does well? What types of stocks do well? Stronger balance sheet companies, basically higher quality, broadly speaking, in terms of more durable and sustainable margins. So Google's an example, or Alphabet is an example of a company that would meet those characteristics. My colleague Eric Sheridan is the analyst who follows it. But if you think about the types of companies we're looking for, larger market cap, more durable or sustainable, lower variation in their profit margins, those are the kind of companies that were likely to do better because they have ability to handle the more difficult financial conditions that we're anticipating going forward. I think it's one of the reasons why you're likely to see a lot more corporate spinoffs that are likely in 2022. You saw almost double the amount of companies that were announced last year, spinoffs. We're expecting more of that this year. And I think that goes to the heart of the idea in a slowing, decelerating economy, more challenging to get revenue growth. One of the other ways to do that is to try to boost margins, efficiency, spending on technology, of course, one way of doing that. Another way is through corporate restructuring, and spinoffs, I think, is one of the vehicles that corporates are going to use.